Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Brian McMullen, Fixed Income ETF Strategist over at Invesco, to discuss how investors are positioning fixed income within their portfolios. Brian, it's great to see you as always. Welcome back to Trade Talks.
Yes, thanks for having me, Jill. It's good to see you too.
Thank you. And how have you seen ETF investors position fixed income in their portfolios amid the volatility that we've experienced so far in 2023?
Yeah, well, it's been an interesting start to the year. When you look at measures of interest rate volatility, especially just over the last few weeks, we've reached levels that we really haven't seen since 2008 or 2009, so the height of the financial crisis. So very elevated levels of volatility across fixed income markets. But I think what's interesting is that despite that volatility, investors have not shied away from fixed income ETFs. So if you look at fixed income ETFs, they make up about 20% of the assets in the overall ETF market. But year to date, they've accounted for roughly 60% of all net inflows into US listed ETFs. So extremely strong start to the year. But when I take a look at our lineup at Invesco and I look at where our clients are allocating in this type of a market environment, we really see a lot of consistent demand for our BulletShares ETFs or our defined maturity ETFs. And I think a key driver for this is just the fact that clients are really starting to rethink the way that they construct fixed income portfolios. So, 2022, it was one of the worst years on record for a 60-40 portfolio. And I think clients are really increasingly looking at ways to better insulate portfolios from interest rate volatility. And I really think that BulletShares can offer a solution to that problem, especially in this type of a market environment.
So Brian, tell us more about the Invesco BulletShares ETF suite and some of the potential benefits that they can offer for fixed income investors.
Sure. BulletShares were really designed to provide investors with an experience that's very similar to owning an individual bond, but trying to combine that experience with all of the benefits that come with the ETF vehicle, right? So if you think about why investors like owning individual bonds, well, it's really for that aspect of predictability, that aspect of visibility that you get with an individual bond on your future cash flows and your future return streams, right? If you buy an individual bond, you hold it through till its final maturity. All you're doing is you're just simply clipping the coupon and you're getting that principal or that par value back at maturity, right? So it's taking that aspect of visibility, of predictability on future returns, but combining it with the diversification, transparency, liquidity, low cost benefits of the ETF, right? So when you think about, how are BulletShares actually structured to achieve that goal, essentially all we're really doing is we're taking bonds and we're allocating them into the portfolios according to their effective maturity dates. So for example, if you own a 2025 investment grade corporate BulletShare ETF, you're looking at a portfolio of bonds that are all going to either have a maturity date in 2025, or they're in some cases, being priced to their call date in 2025. And once we have the bonds allocated according to that effective maturity date, the beauty of BulletShares is our goal is we're holding those bonds through till their final maturity. So it's that hold to maturity aspect of a BulletShare that allows a client to purchase a fund and have that clear visibility, that predictability similar to an individual bond that you don't necessarily get with more traditional bond ETFs or bond mutual funds that are constantly selling bonds prior to their final maturity.
And finally, Brian, what are some ways that you see clients implementing BulletShares ETFs into their portfolio's?
Well, I think there's a number of ways. I'd say the earliest adopters of BulletShares and probably one of the larger bases of our clients, they were those advisors, those investors that traditionally went out and purchased individual bonds and did that across multiple maturities and tried to do that at scale across multiple client accounts. And, the last 10, 15 years, that's become extremely difficult, increasingly challenging to do for investors. And so a lot of those clients find BulletShares as a much more efficient, cost-effective way to get that type of strategy or that type of exposure. And I'd say a growing use case over the last, call it 12 to 24 months has really been more traditional mutual fund clients. So clients that have owned traditional bond mutual funds and saying, we're either going to replace that strategy with a BulletShare or a handful of BulletShares, or if not, certainly complement that core bond mutual fund with a BulletShare ETF, just to provide, again, some of that predictability, a little bit better outcome around what that total return stream might look like for that section of the fixed income sleeve.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.